Hi, and welcome to Random Rogers Big Picture for the week of December 28th. Just going to talk about a couple of things. First, the weather. We are snowed in here. We were able to get out Christmas Day. Then when we got back, it was raining like crazy, like a sleety, slushy rain. And then it froze overnight and never thawed up on Friday. Saturday, it's not going to thaw up either. So we live up a hill like that is a sheet, and it turns like this, and it's a sheet of ice. I walked down to get the mail on Friday and saw a car stuck. It is just, nasty business. It's great if you've got no place to go, but if you've got to be somewhere, you've got a problem. Talking about market stuff for today, kind of I guess an analogy from life, and as it can apply to investing. It's a repeat of something I've talked about many times, but it always bears mentioning, which is the notion of, the easiest solution or keeping things simple along those lines. Two things from yesterday. One, I'm not going to give you the details of the story, but a relative with some sort of problem, it's like the problem is San Diego, the answer is Los Angeles, yet the relative's going to be hanging out in Kentucky for a while, if you know what I mean. Just not recognizing that there is a much simpler solution. Last night, for clarity's sake, Christmas night at about 10:30, I think it was, or quarter to 11, something like that. It's a pouring rain, ice slushy rain. And apparently, as I found out going out and about Friday, the trees had fallen all over the place. There was a lot of wind and a lot of trees got topped. And someone called the fire department because a tree fell, took out their power line, and the person lives 2 doors away from me. So I had to walk over there in the pouring rain with a flashlight, only to look up at the thing and say, yeah, there's nothing I can do. You need to call the power company. It was an easy solution, and they, just couldn't grab onto that which was simple. In, talking directly about simple, I think I'll pick kind of a continuing theme that came up about REITs, and you can apply this to anything. If you put 20% of your portfolio into some sort of narrow-ish asset class, like REITs or commodities or emerging markets, and that narrow segment gets crushed, what's going to happen to your portfolio? Well, the simple answer, sticking with the theme, the simple answer is that your portfolio is going to have a big drag. Now, recognizing this is not necessarily any sort of forward-looking analysis. It's putting yourself in a position of not having to be right about a forward-looking analysis. If you put 20% into commodities, you got to be right. It's crucial that you're right, or you really damage yourself. With how commodities ended up going. And people view the people that say 15-20% or more in commodities are viewing it as a distinct asset class. Well, if you put 20% of your money into an asset class that cuts in half or more, depending on how you put it together, you're losing 10% of the overall pie just from 20% of the account. The simple solution is small weightings. I read some sort of thing on Advisor Perspectives. I don't know why I get this in the email, but occasionally they have something interesting, and it was talking about a very simple portfolio with 5 or 6 things, beating a very quote-unquote sophisticated portfolio which had a whole bunch of things and had small weightings. So I kind of lean toward having smaller weightings in a whole bunch of things, but once you buy the thing, and I think this gets lost in the translation sometimes, that does not mean that you never then make a change. It requires that you continue to monitor anything that you own. If you own 3% or 2% in something that craters, you probably don't need to make a change. But if you own, here's a good example: the convertible bond funds, which I sold out of this week. I had most clients had 2%, maybe 3%, and then it was something small, and they cratered. They didn't blow anybody up. If I had 10% in there and it dropped 75%, all of a sudden, that's a big problem. You put 10%, people leave comments anytime I talk about something about, they talk about putting 5 or 10% in there. Well, putting 10% into something, all of a sudden you've ramped up the amount of work you need to do and ramped up the importance of being right on the future direction of any of these things. And I think that gets lost in the translation. It's a crucial point of understanding for giving yourself a better shot at portfolio success. Most people wouldn't think of 10% as a big bet, and I don't know that I can really defend very well the point that it is a big bet. But other than foreign equities and domestic equities, I don't go anywhere near 10% in anything. That is, it just doesn't. You're setting yourself up to be more exposed, more vulnerable. That's a better word. More vulnerable to something unexpected and nasty. REITs got crushed. They offered protection. As I think about the chart that I looked at and making the post the other day, they offered protection for a couple of months and then they imploded. You really need to understand that even 10%, which doesn't sound like much, can be an awfully big bet. Think about all these people that put 10% only in Madoff, and it's flushed. 10% gone. That can't come back. That is, you can't lose sight of that, which is why I make, chicken-sized bets. I think it was this week, but it might have been the week before. I bought a corporate bond for a healthcare company. Tiny little weight, maybe 2% of client portfolios in that. If the healthcare company somehow goes bust, and given that they have, their cash flow is larger than their total outstanding debt, I don't think that's possible. But if somehow it goes busts, well, that was a dumb pick. But it's 2% of the portfolio, big deal. The tech wreck should have taught everybody this fact of not loading up. And at least it made a huge impression on me to not get taken down by any one thing. Hopefully you realize that. And if you hadn't before, hopefully you do now. This is crucial to not getting decimated. The market's down 40%. If you're down 40% along with the market, that really does suck. But that's nothing like being down 70% because you made some big bets and they turned out particularly sour. Think about that. There are people in that position. Hopefully that's not you. All right, that's it. Have a great weekend.